Good afternoon to each one of you. Happy afternoon to each one of you. As Kajal Madam already informed us, today's topic is on IVS 105, which is on valuation approaches and methods. So, as you are aware, the IVS or International Valuation Standard, these have been divided mainly into two parts. Number one, general standard, and number two, asset standard. So a general standard, we have 5 in number, IVS 1012, IVS 105, and we have 8 asset standard. So that will start from IVS 200 and end at IVS 500. So in all, there are 13 standards, 5 general standard and 8 asset standard. And as we all are aware, the general standards, these are applicable to all types of valuation estimation or all types of valuation assignment, whereas asset standard, these are applicable to specific assets. Amongst the general standard, according to me, IVS 105, that is most important because that is related to the valuation approaches and method. So once the valuer gets the assignment and he finalizes the scope of work with the client, and then he is making a due diligence in which he will collect the documents, projection, information from the client or from other sources, and then he will finalize the basis of value and a premise of value. So guidance on that, as we are aware, is given under IVS 104. And after that, prior to starting the actual evaluation assignment or estimation, the valuer need to finalize the evaluation approach and evaluation methods. So as we are aware, worldwide, globally, there are 3 valuation approaches which are recognized, and these 3 approaches are a market, income, and a cost approach, or MIC. I always refer to is at kal aaj aur kal. So why it is kal aaj aur kal, or yesterday, today, and tomorrow? So that I will explain in a little while. But 3 approaches. And as we are aware, the international valuation standards were last revised effective from 31st of January 2022. Prior to that, actually, IVSC, or International Valuation Standard Council, who are responsible for notifying the international valuation standard, so they had issued one discussion paper, and they had actually sought views of stakeholder on a certain proposed amendment in the international evaluation standard. So that is the usual practice whenever any regulatory body, if it wants to make certain changes or any statutory law provision. So generally comments are invited from the general public or from the concerned stakeholder. So in this case, the IVSC invited comments on a proposed amendment to IVS, International Valuation Standard, prior to finalizing it and making it effective from January 2022. So one of the amendment was to incorporate a new valuation standard, 4th valuation standard, a hybrid valuation approach. So that was the proposal in the discussion paper on which IVSC invited comments from the stakeholder. So stakeholder, they presented their comments, and afterward, the idea of having a 4th valuation approach, that is hybrid approach of valuation, that idea was dropped or not implemented, at least in a January 2022 version of the International Valuation Standard. Maybe in future we have a 4th valuation approach, but now we have only 3 valuation approaches which are globally recognized, whether we are doing valuation in India or whether we will any assessor or valuer doing valuation in USA or in China or in any European country or in Singapore, the valuation approaches are three only: market, income, and a cost approach. So marketing approach, as we all know, that is a relative approach of valuation. So a relative valuation about actually is done. A valuer actually collect the information about recently concluded a transaction of a similar asset or a similar company, and based on that he will make certain adjustment to arrive at the estimated value of the subject company or a subject asset. So that is the relative valuation. Under income approach, we all are aware. So projections of case inflow are made actually. So what income will be generated from the company or asset, those projections are made, and that will be converted to its future present value, because all this case inflow will be accrued at a future date. So that need to be converted to its present value. That is what done under the income approach. And under a cost approach, what we valuer actually do, he actually find out the replacement as a replacement cost or a reproduction cost of the asset which is under a valuation, or the subject asset or a subject company. So these three are the approaches. We will see it in more detail when I make my presentation. Market, income, and cost. Now a question will come: which valuation approach that is widely used in valuation assignment? So it is naturally the market approach, because ultimately market approach is a relative approach, not absolute approach as income approach. So market approach is considering the means value or a price of the recently concluded transaction. So ultimately what is what value is decided by the market, that will always have upper hand. Around 70 to 80% valuation estimation world over globally that are actually done by a market approach, or taking a market approach as the primary valuation approaches. So that is the means that is the findings of a recently concluded survey. And the income approach that is used in 20% cases, around 20% cases, as a primary approach of valuation, primary method of valuation. So that is about the use of valuation approaches. And now coming to valuation methods. So under these three valuation approaches, there are many evaluation methods. So some of these methods are recognized in the international evaluation standard, but it is specifically mentioned in the IVS 105. Whatever list of evaluation method that is incorporated against each evaluation approach in IVS 105. So that is just illustrative purpose. That is not a exhaustive list of valuation method. So apart from the valuation method which are mentioned in the IVS 105, a valuer can actually design his own method of valuation, his or her or its own method of valuation, depending upon the ground reality of each assignment, or depending upon the information and document which are available to the valuer at a particular point in time. So how it is done practically, so that also we will see. So in my presentation, as you will appreciate, IVS 105, that is a very wide coverage, and even a session of 4 hours is not enough if we discuss it in a greater detail. So what I have done in my presentation, I have taken out certain important paragraphs from the IVS 105, which we will discuss. And apart from that, what I have done, I have actually incorporated certain practical aspects of all three approaches, because that will only matter. So how actually the cost of capital is decided by the market participants, or by the valuers in a real field, so that we will see some detail of that. So my effort will be to give as much input as possible in this short session of less than 2 hours. So with that background, what I will do, I will now share my presentation. So just give me a minute. I will share my PPT. So I hope my PPT is visible to each one of you. If you face any issue in visibility of the PPT, you may interrupt me anytime. And if you have any question during the session, I request you to please unmute yourself and ask your question anytime. Whenever you are not talking, so my request to each participant, keep yourself mute so that we can go ahead smoothly. So IVS 105, valuation approaches and methods, that is our today's topic of discussion. And as we have already discussed, IVS, or International Valuation Standard, that is divided into two parts: general standards and asset standard. So what is the meaning of general standard? That is given in the IVS itself. So a general standard is set forth requirement for the conduct of all evaluation assignment. So whether evaluation assignment is related to valuation of plant and machinery, or land and building, or securities, or financial asset, so valuer need to consider a general standard in all evaluation assignment. Whether valuation is of equity share, whether valuation is of company, whether valuation is of fixed income security, or whether valuation is of financial derivative, all type of assignment, general standard will be required. You know, so these general standard will set forth the requirement for the conduct of all evaluation assignment, including establishing the terms of evaluation engagement, basis of value, valuation approaches and methods, and reporting. So they are designed to be applicable to all evaluation of all types of asset, and for any evaluation purposes. So that is general standard, and that is how its name is a general standard. So applicable to all evaluation assignment, whether for any purpose, for any assets type. So that is the general standard. And now we will move to asset standard. So asset standard will include a requirement related to specific type of asset, and these requirement must be followed in conjunction with the general standard. So these asset standards are complementary to the general standard. Asset standards are not independent standard. So whenever you are referring to or making use of asset standard, you need to follow the general standard, whatever guidance is provided under the general standard. So asset standard, in other words, are complementary in nature, not exhaustive standards. So these requirement must be followed in conjunction with the general standard when performing a evaluation of specific asset type. And asset standard will include a certain background information on the characteristics of each asset type that influence value, and additional asset specific requirement on a common evaluation approaches and a method used. So that is the meaning of a general standard and asset standard, two separate part of international evaluation standards. Now, as we all know, but this is just for a revision purpose. So as we all know, there are five general standard, starting with IVS 101, ending at IVS 105. And 101 is scope of work, 102 investigation and compliance, 103 reporting, 104 a basis of value. So that we covered in last week's session. I know I am not aware how many of you attended our last week's program on IVS 104, basis of value. So last Saturday we discussed about basis of value, and now today's topic is 105, evaluation approaches and a method. So that is a general standard, and as we are aware, there are 8 asset specific standard, starting with IVS 200, ending at IVS 500. So IVS 200, that is a business and a business interest. So mainly it is related to the amalgamation or mergers related transaction. IVS 210, a very important asset standard relating to the intangible asset. So as we all are aware, according to guidance provided under the accounting standard, whether it is IFRS, International Financial Reporting Standard, or whether it is INDES, Indian Accounting Standard, the internally generated intangible asset are not reported in the financial statement. So that is the drawback, or means as we are aware, the modern companies or recently constituted companies, maybe it is the e-commerce company, or maybe it is IT company, or maybe it is aggregators, they derive their value mainly from the intangible asset. They are actually lean companies. They are referred to as the lean companies. So their asset base is a very less asset base of the tangible asset, that is very less in value, and they derive a value mainly from their intangible asset. So that is IVS 210. And again, according to a recent survey, findings of a recent survey, so world over, globally, around a third of the value of intangible asset that is not reported in the financial statement, that is out of a financial statement, and that amount is in billions of US dollar. 2/3 of the internally generated intangible asset are not a part of a financial statement. And many experts say now it is a time to go tangible about the intangible asset. So that is the importance of intangible asset. And again, as per a recent survey in USA of S&P 500 companies, so in 2021, the whatever valuation was done, so 90% of that value was derived from the intangible asset. So 10% value only derived from tangible asset, whereas 90% derived from the intangible asset. So that is the importance of the intangible asset. And then we have IVS 220, a financial liability. IVS 230, as we are aware, that is a newly added asset standard, and that is added from January 2022. Prior to January 2022, in international valuation standard, there were 7 asset specific standard, and now we have 8 standard. And inventory, as we are aware, that is the very important, because in a financial statement, inventory is reported either at cost price or net realizable value, whichever is less. So that is the guidance under accounting standard, and because of that conservative approach in reporting of financial statement, the true fair value of the inventory, that is not reported in the financial statement. And inventory, that is one of the high value asset on asset side of the balance sheet, and that is the high value, means highest value in income statement in the form of cost of goods sold. So very important. to arrive at the fair value of the inventory. IVS 300 is on plant and machinery. IVS 400 real property interest, so real estate company. 410 development property, and 500 again a very important standard on a financial instrument. So financial instrument will cover financial assets as well as financial liabilities. So very important topic. So these are 8 asset standard. And what is the meaning of valuation approach and valuation method? So that is given under clause 20.25 of glossary. So valuation approach. So that is a way of estimating value that employs one or more specific valuation method. So that is what the valuation approach. It is a way of doing or estimating the value. And a valuation approach, what is the meaning of valuation method? So that is given under clause 20.26 of glossary in IVS. So according to it, within valuation approaches, that is a specific way to estimate a value. So choice of valuation approach that will depend on the specific circumstances of the asset or a business being valued and the purpose of the evaluation. So in evaluation estimation, as we all are aware, nothing can be generalized. That all will depend on individual assignment. So each and every presumption in evaluation estimation or assumption in evaluation estimation, that will be different from one assignment to another assignment. So that is very important. And moving forward, so as we already discussed, we have market approach, income approach, and cost approach, MIC, or we call it as Kallaj or Kal. Why it is Kallaj or Kal, or yesterday, today, and tomorrow? Because whatever cost is incurred, that is thing of the past, so that is relating to yesterday. And whatever price is prevailing in the market, that is thing of today. So that is a market approach. And income approach means whatever value that will be depend on the income generated in a future. So that is thing of tomorrow. So Kallaj or Kal, or MIC, market, income, or cost, whatever name we may call it. So these 3 approaches are accepted globally, worldwide, 3 valuation approaches. And under these actually, so what is the evaluation approach? So we all know that, but in brief, market approach that will provide an indication of value by comparing the asset with identical or a comparable asset for which price information is available. So that is market approach. Relative valuation method. Income approach, absolute valuation method. So that will provide an indication of value by converting future cash flow to a single value. So that is a income approach. So a concept of time value of money is used in income approach. And those of you who are from finance background, so you may be aware, we are making use of a DCF. So DCF is the main method under income approach. Discounted cash flow method. So we are making use of that in a capital budgeting decision, maybe to find the IRR or internal rate of return, or NPV, net present value, or ARR, accounting rate of return. So that is what income approach is. Cost approach, we are aware that will provide an indication of value using the economic principle that a buyer will pay no more for an asset than the cost to obtain an asset of equal utility. So that is what equal utility, that is very important, and that is what a cost approach is. Now these are the methods under a market approach as per IVS 105 and as per ICAI evaluation standard 103. So as we are aware, in India, Institute of Chartered Accountant of India, they have notified the valuation standard. Just for information, I have highlighted valuation methods under both these valuation standard. So IVS 105 market approach, we have comparable transaction method or guideline transaction method. then guideline publicly traded comparable method and other market approach consideration. And this IVS, ICAI VS 103. There the valuation method specified under market approach. So these are a market price method or a comparable companies multiple method or a comparable transaction multiple method. So quickly, these are the methods under the market approach. And moving forward, income approach. So under income approach, IVS 105, there are two methods only. Number one, discounted cash flow method or a DCF method. And there is a indirect reference about the income capitalization method. So under discounted cash flow method, as we are aware, we find out the free cash flow, whether a free cash flow to firm or whether a free cash flow to equity, FCFF or FCFE. So instead of doing that in income capitalization method, directly the income is capitalized to arrive at the estimated value. And one of the method, for example, is a dividend discount method. So that is what the income capitalization method. Two methods and income capitalization method that is referred or incorporated with indirect reference under IVS 105. So under ICAI valuation standard 103, we have a discounted cash flow method, which is common with IVS 105. But apart from that, we have relief from royalty method, multi-period excess earning method, with or without method, and option pricing method. So a question will come, why these methods are not part of IVS 105? This relief from royalty method, multi-period excess earning method, with and without method, as we are aware, that is used for evaluation of intangible asset. Instead of incorporating these method in IVS under a general standard, these method are specified in IVS 210. So IVS 210, as we are aware, that is asset standard for evaluation of intangible asset. So in IVS 210, there are 5 methods which are specified for evaluation of intangible asset. So apart from these 3 methods, that is RFR, MEEM, WWM, there are 2 additional methods under IVS 210, which are a greenfield method and a distributor method. And option pricing method, so that is used for evaluation of option contract, which is a financial derivative. But option pricing method can also be used for evaluation of equity, evaluation of the ESOP, evaluation of share warrant, evaluation of entire enterprise also. There are technicalities involved in that, but option pricing method, there are multiple use of option pricing method. So that is about the income approach. And moving to cost approach. So as you can see, 2 methods are common under IVS 105 and ICAI valuation standard 103, replacement cost method and reproduction cost method. But in IVS 105, there is a third method, summation method. So summation method, as we are aware, that is applicable to mainly to the diversified companies. So a diversified company will have more than one businesses. Like if we take example of Reliance Industry. So Reliance Industry is involved in multiple types of business like oil and gas, petrochemical, retail business, telecommunication business. So if a valuer actually need to value a Reliance at corporate level, so that may not give a correct picture because the characteristics of all these business, these are actually different. So what a valuer will do, he will actually value these businesses separately, like telecommunication, retail business, and the what you call oil and gas of Reliance. And after that, he will add up the value to arrive at the aggregate value of Reliance. So that is what is the summation method. a company which is having a more number of subsidiary, so each subsidiary will be valued separately based on its characteristics, and then a value will be added together to arrive at the composite value of the principal and all subsidiaries. So that is what a summation method is. Now, actually, we will move to IVS 105. So I have, again repeat, I have taken only important paragraphs. This is introduction paragraph, para 10.1 and 10.2. So IVS 105. So consideration must be given to the relevant appropriate valuation approaches, and one or more valuation approaches may be used in order to arrive at the value in accordance with the basis of value. So basis of value that is provided in IVS 104. So that can be either market value or market rent or liquidation value, whatever it may be. Based on the basis of value, the valuation approaches will be finalized by the valuer, whether it is one approach or multiple approach. So that need to be decided by the registered valuer based on a ground reality of each valuation assignment, or based on the document or a detail available with the valuer. One or more valuation approaches may be used in order to arrive at valuation, in order to arrive at the value in accordance with the basis of value. And three approaches, as we already discussed, three approaches described and defined below are main approaches used in valuation. So they are all based on economic principle of price equilibrium, anticipation of benefit, or a substitution. So these are the economic principle which actually we learned during our student age. So they same economic principle or principles of economic, these are used in designing or finalizing the valuation approaches. So how it is done? So what is price equilibrium, anticipation of benefit, or a substitution? So that we will see in a greater detail. Based on these principle, actually the principal valuation approaches are finalized, which are market approach, income approach, and a cost approach. And each of these valuation approaches will include a different detailed method of application. So which are those detailed method that we have seen in a previous slide against each evaluation approaches. So that is what the guidance from this particular paragraph, para 10.1 and 10.2. Moving forward, so what is economic equilibrium, means economic principle like price equilibrium, anticipation of benefit, or a substitution. These highlight different valuation method are rooted in fundamental economic principle. So these are the fundamental economic principle, and we learned about these principle during our student age. Maybe due to passage of time, it may not be in our memory, but we all learned about this fundamental economic principle, and from that only these three evaluation approaches are derived. So what is price equilibrium? So that is we have learned about that economic principle. So that refers to the idea that price of an asset or a good is determined by the forces of supply and demand in the market. So that is how the market approach. So in market approach, we are making use of the price equilibrium theory. And according to it, valuation method that are based on these principles, like a market, aim to estimate a fair market value of an asset based on how similar assets are priced in the market. So that is the philosophy of market approach. That is the ultimate aim of market approach, to arrive at the price equilibrium and you all will agree with me. We learned in greater detail about this fundamental economic principle during our student age. Now, what is anticipation of benefit? That is another fundamental economic principle. Anticipation of benefit that refers to the idea that an asset is valuable because it can generate a future cash flow or benefits. So that is a first requirement of anticipation of benefit. So at the time of valuation, whenever we are making a valuation through the income approach, so we need to keep this in mind. That is idea that an asset is valuable because it can generate the future cash flow or a benefit. So many time we come many time we come the valuation assignment. We get valuation assignment of a distress company. So at the time of distress company, particularly when we are using the income approach, we need to consider whether a company is capable of generating the future income or not. And in a case of startup valuation also, so that need to be considered whenever we are doing the valuation of a startup company through income approach. Asset is valuable because it can generate a future cash flow or benefit, and valuation method that are based on this principle, like discounted cash flow method, so that attempts to estimate present value of an asset, a future cash flow, considering the time value of money and a risk associated with those cash flow. So that is what precisely the income approaches or a DCF method under income approach, and that is actually based on the fundamental economic principle of application, anticipation of benefit. So that is the second approach. Moving forward, a third economic principle, a fundamental economic principle of substitution. So this refers to the idea that an asset is worth no more than the cost of obtaining a substitute asset that will provide the same benefit. So that is what a cost approach is, and a valuation method that are based on this principle, like cost approach. So that attempt to estimate the value of an asset by determining the cost of replacing or reproducing the asset, considering the depreciation or obsolescence. So that is what the cost approach is. So I hope these three approaches, there is a new method of looking at these three approaches. We can always relate these three approaches with the fundamental economic principle which we learn during our student age. Moving forward, so this is from para 10.3 introduction, very important guidance. So goal in selecting the valuation approach and method for an asset, that is to find the most appropriate method under particular circumstances. So that is very important, and nothing can be generalized. No assumptions can be generalized in a valuation exercise. So that is once again highlighted here. No one method is suitable in every possible situation. So we cannot say, since in a previous assignment we have done the valuation as per income approach, in second assignment also I will accomplish the evaluation going by the income approach. So that is not correct way of doing the evaluation. No method, no one method is suitable in every possible situation, and a selection process should consider at a minimum. So how actually question will come, how to select a evaluation approach. So for that, this guidance is very important, how to select a evaluation approach or evaluation method. So for these are the minimum requirement. The appropriate basis of value and premise of value. Again, that is part of IVS 104, a basis of value and a premise of value. determined by the terms and purpose of the valuation assignment. So what is the purpose? So if a valuer need to find the liquidation value, so he cannot go by the income approach, because that will give the wrong estimation. So a purpose of valuation and a terms of contract. So many time actually client insist you will do valuation as per market approach. So terms of contract also are very important. If that actually agreed by the client and the valuer as part of the valuation assignment agreement, so necessarily the valuer will follow the market approach of valuation. So if I give you one example of that, so as you all may be aware, presently the amalgamation or merger of HDFC and HDFC Bank, that is in progress. So there actually, if you go through the valuation report, which is issued by the registered valuer for determining the exchange ratio. So all these valuation reports are no longer confidential. These are available either on internet free of cost, or from MCA website on payment of cost. Means in that actually the terms agreed was a valuer will do valuation as per the market approach. So wherever it is decided as a part of agreement, so necessarily a valuer will follow the particular approach which is predetermined. So appropriate basis of value and a premise of value determined by the terms and purpose of the valuation assignment, terms of the valuation assignment or a purpose of the valuation assignment, and a respective strength and weakness of the possible valuation approaches and a method. So if I use income approach, what are the benefit or strength? And if I use the income approach, what are the weakness of that, or what are the disadvantages of that? So that needs to be finalized by the valuer. And the appropriateness of each method in view of the nature of asset and approaches or a method used by participants in the relevant market, and availability of reliable information needed to apply the method. So supposing I am deciding to go by the market approach, necessarily I should have the detail about the recently concluded transaction of same asset. Supposing it is a startup entity, or supposing it is a valuation of means intangible asset, and more particularly valuation of patent. So valuation of patent, as we are aware, the patent are granted for a novel idea. So unless that patent rights are licensed, it will be very difficult to get the comparable or a multiple relating to that particular patent valuation. So there, even if I decide I will go by the market approach, but I will not get the reliable information, and therefore I need to change my viewpoint. So that is what is highlighted: availability of reliable information which are needed to apply the evaluation approach or evaluation method. So this is again from para 10.4 and 10.5. So valuers are not required to use more than one method for the evaluation of an asset. So many times a question is asked, how many approaches a valuer need to take into consideration at the time of evaluation, whether to go by one valuation approach, or whether to go by a multiple valuation approach, or whether to go by multiple methods under a particular evaluation approach. So many times we come across such question. So for that, actually, a guidance is provided here. Again, a very important guidance. Valuers are not required to use more than one method of valuation of an asset, particularly when a valuer has high degree of confidence in the accuracy and reliability of a single method. given the facts and circumstances of the valuation engagement. So that is the bottom line when a valuer is having high degree of confidence in the accuracy and reliability. But generally, because always we have one complaint as a registered valuer. So whatever information we require from the client, majority of the cases we may not get in the fashion or in the design in which we require. Ultimately, we conclude that whatever information is there, either that is not reliable or that is not accurate, because the priority of the client that will always be different. So based on that, he may not give the accurate information, particularly in Indian scenario. I will not discuss much because you all are experienced people. So what is reflected in a financial statement and what are the correct transaction of the entity or company, that will always be a different. So that if we take a financial statement information as accurate or reliable, probably we may end up with having a wrong valuation, or incorrect or undervalued or overvalued valuation estimation. So wherever it is a valuer is confident, he can use one method only. But wherever he is not confident, then what is the way out that is provided here? So valuer should consider the use of multiple approaches and method, and more than one valuation approach or method should be considered and may be used to arrive at indication of value, particularly when there are insufficient factual observable input for a single method to produce a reliable conclusion. So whether to use one valuation approach or a multiple valuation approach, or whether to use one valuation method or a multiple valuation method, so that is explained in this paragraph. And this is again a very important where more than one approach and method is used, even a multiple method with a single approach. So conclusion of value based on those multiple approaches and method, that needs to be reasonable. It is not that one approach is giving valuation of 1 crore rupees, another valuation approach is giving a valuation estimation at say 10 crore. So such wide difference should not be there between two valuation approaches. That should be reasonable, and the process of analyzing, reconciling the differing value into a single conclusion without averaging. So that is very important. One approach I have got 1 crore value, another approach I have got estimated value of 10 crore. So 10 plus 1 11, and I will average it out. So I will arrive at 5.5 crore valuation. No, that is not the guidelines which is given under the IVS. So without averaging should be described by the valuer in the report. So that needs to be necessarily described in the evaluation report. And while this standard will include a discussion of certain method within cost, market, and income approach, it does not provide a comprehensive list of all possible method that may be appropriate. So that is I actually highlighted in the beginning. So whatever methods are described in the IVS 105 under income, market, and cost approach, so that is not a comprehensive list. So that is what is described. It does not provide a comprehensive list of all possible method. So apart from that, there can be other possible methods also. And it is the valuer's responsibility, a big responsibility on a valuer to choose the appropriate method for each evaluation engagement. And compliance with IVS may require a valuer to use a method not defined or mentioned in IVS. So evaluation approach is necessarily three, but valuation method, even if not described or explained in IVS, and if the valuer select some other method, so that will be regarded as the compliance to IVS International Evaluation Standard. moving forward, when different approaches and a method result in widely divergent indication, so that we have already discussed of value, a valuer should perform procedure to understand why a value indication differ, so why estimate is different, so that reconciliation or analysis valuer needs to do evaluation of that, as it is generally not appropriate to simply weight two or more divergent indication of value. And in such cases, a valuer should reconsider guidance provided in 10.3 to determine whether one of the approaches or method provide a better or a more reliable indication of value. So wherever actually a valuer has used multiple method, and the result arrived from that multiple method are very different, having a very high level of difference. So in that, again, a valuer need to consider whether use of one evaluation approach or method that is sufficient or not, and otherwise he needs to reconcile it. So that is what is a guidance provided here, and a valuer should maximize the use of relevant observable market information in all three approaches. So it is not that the observable market information needs to be used in market approach only. All three approach necessarily a valuer need to have make use of observable market information. So that is a very important, and regardless of the source of input and assumption used in evaluation, a valuer must perform appropriate analysis to evaluate those input and assumption and their appropriateness for the evaluation purpose. So that is a very important, and this we have seen repeatedly, although no one approach or method is applicable in all circumstances. Price information from the active market, that is generally considered to be strongest evidence of the value. So that is how, going by these guidance, as I informed you, around 80% of the valuation estimation that is done using the market approach, because that is the strongest evidence of value, because that is a concluded transaction which will always have a upper hand. And some basis of value may prohibit a valuer from making a subjective adjustment to price information from an active market, and price information from an inactive market. So that may still be good evidence of value, but subjective adjustment may be needed. So we can take example of the stock exchanges having a nationwide presence or regional stock exchanges. So regional stock exchanges that may be considered as inactive market, depending upon the nature of transaction and depending upon the frequency of transaction taking place in those markets. So that is just one example. Apart from that, there can be many more examples. And this is from para 10.9 to 10.10. So in a certain circumstances, the valuer and the client may agree on the valuation approaches, method, and procedure. The valuer will use or extent of procedure the valuer will perform. So that is again the terms and contract agreed by the client and valuer at the time of finalization of valuation assignment. So depending upon the limitation placed on the valuer and a procedure performed, so such circumstances may result in a valuation that is not IVS compliant. So many times actually the client may come out with a certain condition which is not as per the guidance provided in the valuation standards. So that will not be regarded as compliant with the IVS or international evaluation standard. So before making agreement to the terms and condition with the client, a valuer need to ascertain whether those terms and conditions which actually the client need to enforce whether that is as per the guidance provided in evaluation standards or not, or whether that will be in a compliance of the evaluation standard or not, because a valuation report which is non-compliant with IVS, so if it is challenged at a later date, so that may result in a serious consequences sometime. So very important before making agreement on terms and condition of the valuation assignment, the valuer need to go through those terms and condition meticulously. So a valuer may be limited or restricted where the valuer is not able to employ evaluation approaches or a method and a procedure that a reasonable and informed third party would perform. And it is reasonable to expect that the effect of limitation or a restriction on estimate of value could be a material. So that is about important guidance out of this. And now we will turn to a market approach. So that guidance of a market approach that is provided under a 20.1 and a 20.2 market approach. So the market approach, when we need to use the market approach, so that is described here. So a market approach should be applied, afforded a significant weight under following circumstances. So the subject asset has recently been sold in a transaction appropriate for consideration under the basis of value. So supposing the valuation assignment is related to the valuation of equity shares of a listed entity. Those means listed entity to get the price information will be very easy. So in that, this will be applicable. A subject asset has recently been sold in transaction appropriate for consideration under the basis of value. So basis of value may be to ascertain the market value of the equity share of a listed company. So in that we can relate this guidance. Then a subject asset or substantially similar asset are actively publicly traded. So any commodity which are actively publicly traded, or any asset which are actively publicly traded, and there are a frequent or a recent observable transaction in a substantially a similar asset. So that is what the circumstances where a market approach is used. But this may look actually simple, but in reality, actually relating to a two company or a subject company with some other transaction, that is always a challenging task, because we always say in our personal life also, even the nature of two brothers and a sister, that is not similar. So how to find two companies? These are actually very similar or having a similar characteristic. So as we are aware, in evaluation assignment, we need to consider both a qualitative and a quantitative aspect. So even if a valuer will be able to compare the quantitative detail based on the financial statement, but the qualitative details of a two company to match, that will always be a very challenging. So qualitative detail will include the location of the company, or the key managerial person or board of directors of the company, or the suppliers of the company, customer of the company. So all these detail to match two company on this count on a qualitative aspect, that will be a very difficult. So that is a market approach. And although above circumstances would indicate that the market approach should be applied and afforded a significant weight when above criteria are not met, so following are additional circumstances. So when these are the three in a previous slide, these are the three circumstances. These are main circumstances, but even if it is not there, so what are the additional circumstances? So that is what is provided here. A transaction involving a subject asset or a substantially similar asset are not recent enough considering levels of volatility and activity in the market. The asset or a substantially similar asset are publicly traded but not actively, or information on market transaction is available, but a comparable asset have significant differences to the subject asset, potentially requiring subjective adjustment. Information on recent transaction is not reliable. It is based on hearsay or missing information or synergistic purchaser, or not arm's length. Arm's length means transaction not between two unrelated party. Distress sell. So all this information of a recent transaction is not reliable information, and the critical element affecting the value of asset is the price it would achieve in market rather than cost of reproduction, or its income producing ability. Whenever it is not feasible to arrive at the cost of reproduction or to arrive at the projection of its case inflow, their market approach will be used. But here actually a valuer should consider whether any other approaches can be applied and weighted to corroborate the value indicated from the market approach.
I have a
that
question,
is, please go ahead, sir.
My name is Umesh Jauhar. What we are basically discussing here,
Yes, sir.
Client has approached me. He has got some kind of an inventory. Now, this inventory is not a raw material. He is basically dealing with some kind of lab equipment and the items which are not, you have already written, the asset or substantially similar assets are publicly traded, but not actively. Now, this word under B. So that is the question which I am going to ask. He is having an inventory of 4 crores. Now he bought, say, 100 pieces, out of which he sold 80 pieces, and those 20 pieces are lying in his godown for the last 4 or 5 years, right? He has lost the warranty from the supplier. Now, what is the kind of method we should use to work out? Because initially when we started, you said either you have to acquisition cost or the fair value as on date, which may be lesser than the acquisition cost, that has to be shown in the balance sheet. Am I right or wrong?
So, sir, first of all, you actually need to understand what is reported in a financial statement. That is different from the fair value. Because in see, I will explain you in a financial statement for a reporting of inventory, that will be either reported at its cost price or a net realizable value, whichever is less. So conservative approach is adopted. The cost price and a net realizable value, that is not the fair value, because cost price and net realizable value, that is entity specific, not market specific. Because supposing if I give you example, same commodity, the cost price and net realizable value for a wholesaler or a manufacturer or a retailer, this will be different. So based on his or its realizable cost or cost price, that will be reported in financial statement. So what is reported in financial statement, that is not fair value. Now coming to your specific query, how to ascertain the fair value of that
4 crore worth of stock.
So slow moving inventory. So that is nothing but slow moving inventory. So that is not moving. Now you will have to consider many factors according to me in that, whether that why it is slow moving, because there is no market for it. That is the prime reason. Otherwise it would have been sold out. It would not have been kept in go down for a period as long as 4 years, as you are informing. So in that, actually, you need to have the realizable value. So see, you cannot use the cost approach, because that will be irrelevant, and reproduction is not required. you need to income approach, so that will also not be reliable method. So only approach left is a market approach.
Right.
So market approach, you actually need to consider the recent transaction, if any, of not the same apparatus, of not the same lab apparatus, maybe of a similar utility. That
Right.
you need to ascertain. And then another thing you need to ascertain, what is the purpose of valuation. So based on purpose of valuation also, a fair value will be different, whether it is for reporting in financial statement, whether that company has gone into distress and you are ascertaining the fair value, or whether that is for borrowing purpose. So that will actually means that purpose will also define the value, sir.
But the purpose for the company is to, because what they did, that was an inventory which was shown as a cost price, whatever they purchased 4 years back. Now they are showing the same thing. Now they are not able to sell it. They are the only fellows who are selling it in entire India. There is no other fellow who is selling the same product, right? So
Okay.
now if they are selling it for 100 rupees, uh, they are the only fellows who are selling it either for 100 rupees, or in actual, if they sell it in the open market, they have to scrap it, because there is no other way, because they have lost the warranty of 1 year. They are all imported items, So
Yes.
what they want to get it revalued, and they want to book the losses in their balance sheet,
So
They
that
won't
is for
ever-
the purpose of, financial reporting,
Right.
fair value for
You're
the
right.
purpose of
Yeah.
financial reporting. So that for that, sir, you need to go through the guidance which is provided under Ind AS 113. So that you need to refer, sir. Ind AS 113 is a fair value, a measurement of fair value. So either IFRS 13, International Financial Reporting Standard 13, or Indian Accounting Standard, Ind AS 113. So
Okay.
you need to go through the guidance provided in that. There you will get how to ascertain the fair value, sir.
Right. Right. Thank you.
Sir. So that you will. So apart from that, any questions are always welcome, but time is limited. So means the critical element affecting the value of asset, that is the price it would achieve in the market rather than the cost of reproduction and reproduction. So moving forward at 20.4 and at 20.6. So heterogeneous nature of many asset means that is frequently not possible to find market evidence of transaction involving identical or a similar asset. So that is the reality of market approach. It will be always challenging to get the similar asset because of heterogeneous nature of many assets. And even in circumstances where market approach is not used, use of market-based input like should be maximized in application or other approaches, market-based valuation metric like effective yield or rate of return, etc. And when a comparable market information does not relate to the exact or a substantially same asset, the valuer must perform a comparative analysis of qualitative and quantitative similarities and differences between the comparable asset and the subject asset. So all these are highly judgmental, all these are highly subjective, and there actually here actually the skill of a valuer that will come into play. So it is frequently necessary to make adjustment based on these comparative analysis. So adjustment on upper side or adjustment on a lower side, and those adjustment must be reasonable, and a valuer must document the reason for the adjustment and how they were quantified. So that is very important because in the recent past actually, as we all are aware, the authority or IBBI, they have issued the disciplinary orders against the registered valuer. And in that, this is what is highlighting. So my PPT is not visible. Mr. Lakshmanji is having this question. So it is visible to all other participants.
Yeah, it is quite visible. No issue.
Okay. So Lakshmanji, you need to check at your end whether your connectivity is proper or not, or maybe if you have logged in from a mobile, you may be having certain difficulty. Or if
Let
you
me check. Okay, let me check, sir. Let me go ahead.
Please.
Go ahead.
please. So it will be frequently be necessary to make adjustment based on this comparative analysis, and those adjustment must be reasonable, and a valuer must document the reason for the adjustment and how they were quantified. So that is very important. So what I was informing in the recent past, IBBI or the authority has issued a disciplinary orders against a registered valuer, in which it is mainly highlighted the valuer has not documented the full fact based on which the conclusion is arrived at. So very important to make the valuation report as elaborative as possible. And the market approach frequently use market multiple derived from a set of comparable, each with a different multiple. So selection of the appropriate multiple with range requires judgment, considering a qualitative and a quantitative factor. Very important in each evaluation assignment, qualitative and a quantitative factor. So what are the benefits? This is not as per IVS. This is just, we will list down certain benefits of the market approach. So most valuation on major stock exchanges like Wall Street are a relative valuation, and almost 85% of equity research report are actually based on a multiple and a comparable, and more than 50% of all acquisition valuation are based upon the multiple or market approach. And rules of thumb based on multiple are not only common but are often the basis for a final valuation judgment. So that is very important. And this reminds me actually the central government that is devised a investment plan in infrastructure. In a 5 year, they have a plan to invest around 120 billion, means 120 crore rupees in the infrastructure. So there actually Niti Aayog has published the means one report. So under that actually the government has conceived a monetization of asset. So whatever the present assets of the central government, they have actually means estimated around 6% of this infrastructure development will be arrived from a monetization of asset. So there actually different methods of valuations are described in that valuation means a report of the Niti Aayog. And one of the method is a rule of thumb. So if I give example, they have actually they have planned to monetize the natural gas pipeline. So natural gas pipeline, so around 10,000 kilometer of natural gas pipeline, they will monetize that. So there actually they have arrived at a valuation of 3 crore per 1 kilometer of natural gas pipeline. So that is rule of thumb. That is one example of making use of rule of thumb. So rule of thumb based on multiple are not only common, but are frequently the basis for a final valuation judgment. And while there are more discounted cash flow valuation in consulting and corporate finance, they are frequently relative valuation appearing as a discounted cash flow valuation. So that is a reality. And these are the disadvantages or a limitation of using the market approach. So relative valuation is as good as the valuation of comparable company, and suffers from a volatility of the market. In case market is overvaluing a comparable company, the relative valuation will also lead to overstatement of value. So many times actually the basis or comparable which we take, that is already overvalued or undervalued. So based on a selection, we may get either overestimated value or underestimated value. Identifying comparable company with a similar growth rate, business composition, a stage, and a riskiness of business. So that is a difficult task, and finding a perfect match is extremely challenging. So we to be on lighter side, we always said we the natural person, we struggle to get a match which we wish. So artificial entities, companies and all. So same challenge will be there to get a perfect match. So that will be always challenging. And adjusting the multiple for a company specific information is subjective, judgmental, and that is how it will always be debatable also. And a difference in accounting policies related to revenue recognition, depreciation, though adjustable to a certain extent, can result in a distorted valuation. So therefore, I always actually insist whenever we are making a valuation, we need to go through the notes to financial statement, which is incorporated. So in notes to a financial statement, which are appended to financial statement, so that will actually give an idea of policies that a company is adopted in a valuation of, say, inventory. Sir, recently cited the difficulty in evaluation of inventory. So what a company is adopting, a company dealing in a multiple product may have a different evaluation, a policy for inventory for a different product. So that is very important. So a difference in accounting policy related to revenue recognition, depreciation, though adjustable to a certain extent, can result in a distorted valuation. And market approach or a relative valuation is more commonly applied to historical data and can result in undervaluation of a company with a significant future potential or a benefit that may arise due to beneficial circumstances like market expansion and all. So, a moment you are not using a market approach, you are using market approach, you are ignoring income approach, so that drawback will always be there, limitation will always be there. Now, a comparable transaction method, so guidance for that is provided under para 3.1 onwards. So the comparable transaction method, that is also known as guideline transaction method, so that utilize information on transaction involving asset that are same or similar to the subject asset to arrive at indication of value. And a few recent transactions occurred, valuer may consider the prices of identical or a similar asset that are listed or offered for sale, provided the relevance of this information is clearly established, critically analyzed, and documented. So that is the requirement. And this is sometimes referred to as a comparable listing method, and should not be used as the sole indication of value, but that can be appropriate for a consideration together with another method. So that is the comparable transaction, and this example given in IVS is very important. An offer that represent a binding commitment to purchase or a sale an asset at a given price may be given more weight than a quoted price without such a binding commitment. So merely based on quotation, if we arrive at value, so that may not give the correct picture, but there should be some type of binding agreement or concluded a transaction. So moving forward, the comparable transaction method can use a variety of different comparable evidence, which are known as unit of comparison, which from the basis of which form the basis of comparison. Like a few of many common unit of comparison used for a real property interest, that will include a price per square foot or rent per square foot or capitalization rate. So all these are unit of means for the purpose of comparison, units of comparison. And a few of the many common units of comparison which are used in a business valuation, so that we are aware that is EBITDA, earning before interest, tax, depreciation, and amortization, earning multiple, revenue multiple. So earning multiple will include the price to equity ratio. The means this revenue multiple will include sales to enterprise value ratio. So all these are and a book value multiple, and a few of the many common units of comparison used in a financial instrument valuation include a metric like yield and interest rate spread, and units of comparison used by participant that can differ between asset classes and across industry and geographics. So in India, that may be different. In USA, that may be different. So based on geography of the asset, within India also one state, it can be different. Another state, it can be different. So geographic location of the asset, that will also play an important role. And a subset of comparable transaction method is metrics pricing, which is principally used to value some types of financial instrument like a debt security without relying exclusively on a quoted price for the specified security. So that is what is a comparable transaction, and these are the key steps which are involved in valuation through comparable transaction method. So identify the unit of comparison. So how to identify, we have seen in a previous slide. So I like for land per square meter or square foot, etc. So identify the unit of comparison that are used by participant in the relevant market. Identify the relevant comparable transaction and calculate the key valuation metric for those transactions. Perform a consistent comparative analysis of qualitative and quantitative similarities and differences between the comparable asset and a subject asset. Make necessary adjustment, if any, to the valuation metric to reflect the differences between the subject asset and comparable asset, and apply adjusted valuation metric to the subject asset. And if multiple valuation metric were used, so reconcile the indications of value. So precisely these are the steps involved in evaluation, going by market approach, a comparable transaction method. So that is what highlighted here. And a valuer should choose comparable transaction within the following context. So evidence of several transaction is generally preferable to a single transaction or event. So one transaction may not give the correct picture. So in case of comparable transaction, the effort should be made or need to be made to collect the details of multiple transactions. So evidence of several transactions is generally preferable to a single transaction or event. Evidence from transactions of very similar asset, ideally identical, provides a better indication of value than asset where the transaction price require significant adjustment. Then a transaction that happen closer to the valuation date are more representative of the market at date than older dated transaction, particularly in a market with a volatility or a volatile market. So presently, as we are all are aware, because of the ongoing tense relationship between the major economy or a tense diplomatic relationship between the major country. Maybe it is USA and Russia, or Russia or a European country, or USA or China. The markets are very volatile in nature. So a particularly volatile market for most basis of value, a transaction should be arm's length. So that should be a transaction between two unrelated party, not between two related party. So for most basis of value, the transaction need to be arm's length transaction between unrelated party, and a sufficient information on the transaction should be available to allow the valuer to develop a reasonable understanding of the comparable asset and assess the evaluation metric or a comparable evidence, and information on the comparable transaction should form a reliable, trusted source. So here in the era of internet, particularly after the AI-based chat box, means we are aware about the chat GPT. So that may not give the correct or reliable information. So whatever information we get from the chat GPT, if we make use of that, it is my experience because I am using that chat GPT, and many time actually information provided is not correct, and then when we point out it comes out, I apologize for this mistake. So checkbox has that liberty, but valuer will not enjoy that liberty to apologize for the mistake. So if based on valuation report is some commercial transaction is concluded, so naturally that party will make the valuer responsible for it. So whatever transaction detail we are using, that needs to be a reliable information, and as far as possible that should be incorporated. Details of that needs to be incorporated in the valuation report. So from and this more guidance on a comparable transaction method. So valuer analyze and make adjustment for any material difference between comparable transaction and a subject asset. So example of common differences that could warrant adjustment that may include but not limited. So this is just illustrative list, not exhaustive list. So that will include a material characteristic, age, size, specification, etc. Relevant restriction on either the subject asset or a comparable asset. Geographical location, so location of the asset and or location of where the asset is likely to be transacted or used. A profitability or a profit-making capacity of the asset. Historical and expected growth, yield and a coupon rate. Types of collateral whenever some charge is created or asset is hypothecated. So types of collateral and unusual terms in the comparable transaction, comparable and a subject asset and ownership characteristic like legal form of ownership, amount of a percentage held, etc. So that is about the comparable transaction method. So as I informed you, the valuation approach is 105, that is having a very wide coverage. So that will not be feasible to go into a greater detail. So what I am doing, I am now leaving this. I am skipping this guidance on comparable guideline publicly traded comparable method. So that we will come if time permits. But now we will go to the income approach. So so that we cover income approach. So that is actually guidance given from para 52 to 53, IVS 105. So that is on income approach. So under the DCF method, so a discounted cash flow method, the forecasted cash flow, that is discounted back to valuation date, resulting in a present value of the asset. And in some circumstances, for a long-lived or indefinite-lived asset, a DCF may include a terminal value, which represent the value of the asset at the end of explicit projected period. So as we all are aware, a valuation under a DCF, that is divided into two parts. Number one, explicit period, and number two, terminal value. So explicit period, that is generally taken at 5 years. Because it will not be feasible for a valuer to make a projection for a longer duration. But that is not a conclusive guidance. Wherever it is feasible to make projection for a longer duration or for a shorter duration. So the explicit period that will be amended accordingly. For a long leave or indefinite or a going concern companies, the DCF will be divided into two parts: explicit projection period and a terminal value. And in other circumstances, a value of an asset may be calculated solely using a terminal value with no explicit projection period. And this sometimes referred to as income capitalization method. So these are the steps involved in a DCF method. So this is as per the guidance provided under IVS. So choose the most appropriate type of cash flow, whether a cash flow is a pre-tax, after tax, whether cash flow, free cash flow to firm, a free cash flow to equity, whether that is a real cash flow or a nominal cash flow. Real cash flow is as we are aware, that is inflation adjusted cash flow, or nominal is without adjusting to inflation. So these type of cash flow are very important. So choose the most appropriate type of cash flow for the nature of a subject asset and the assignment. Thank you, Amrutlaji, for your kind words. So a type of cash flow for the nature of the subject asset and the assignment, like a pre-tax, post-tax, total cash flow to equity, real or nominal, and then determine most appropriate explicit period over which cash flow will be forecast, and then a cash flow, prepare a cash flow forecast for that period, and then determine whether a terminal value is appropriate for the subject asset at the end of the explicit forecast period, and then determine the appropriate terminal value for the nature of asset, and determine appropriate discount rate and apply a discount rate to the forecasted future cash flow. So this is precisely the DCF method. And what we will do, we will this guidance is there. This you can either read from my this PPT or from IVS. So since time is less, so what I will do, I will take you to the finding of one survey on a cost of equity, which is very important. So this particular survey that was conducted by the National Stock Exchange, that is NSE, and EY. So EY, as we are aware, that is a renowned consultancy firm. In 2021, they had conducted this survey, cost of capital survey, India Insight. So this survey document is freely available on the internet. And apart from that, there are a mini survey on a cost of equity on internet. On a need basis, we can get which are available free of cost. So only important portion from this particular survey, cost of capital survey, India Insight 2021, that I have incorporated here. First is a basis of estimating the cost of equity. So how to estimate the cost of equity? That is the first question will come before the valuer whenever he is making use of a DCF valuation method. So this survey will finding of this survey will highlight that. Most companies in India, that is greater than 50%, prefer using organization a specific hurdle rate as the cost of a capital. So that is according to me, this is not a correct way of estimating the cost of equity, because hurdle rate, as we all are aware, that is used by many companies in making a decision relating to the capital budgeting. So at the time of selection of a project, companies actually decide a certain hurdle rate, and then they decide whether to invest in that particular capital project or not. So hurdle rate is not market specific, that is the company specific, which is used for the purpose of decision on a capital budgeting. not in valuation, but still this is the finding. So a 50% prefer using organization specific hurdle rate as their cost of capital, and a little over one third of the respondent indicated that they use the CAPM approach. So CAPM approach most important capital asset pricing method. So one third are going by the capital asset pricing method, which is in contrast to the developed market of US and Europe, where application of CAPM in a discount rate estimation that is much more widespread. So in a USA, in a developed country of Europe or European country, they make use of a CAPM or a capital asset pricing model. So we all of us know the formula to compute the CAPM, cost of equity going by CAPM, that is nothing but a risk-free rate. So risk-free rate is market specific, it is not a company specific. So generally it is a government security rate. So risk-free rate plus beta into the equity risk premium. So all these are market specific measure, not a company specific measure. And therefore the CAPM is used widely in USA and European country. From these actually we have got two methods of arriving at cost of equity. Number one, organization specific hurdle rate. Number two, a CAPM. So what is the third method of arriving at cost of equity? So given the volatility seen in equity market in the recent times, so this survey was conducted in 2021, and we are aware about the implication of pandemic COVID-19. So at that time, there was a very high volatility in the equity market. That is what is highlighted here. So given the volatility seen in equity market in recent times, a trend observed in the previous survey of using a bank lending rate with a necessary adjustment continues to be a preferred benchmark for a cost of capital for nearly a 20% of the respondents. So that is the third method of arriving at cost of equity. Build up rate. So a bank rate is taken as benchmark, and certain adjustment based on characteristic of the company. These are made to arrive at the cost of equity. So that is third method, and use of a bank lending rate as the starting point for a discount rate estimation. This was observed predominantly in FMCG, consulting, healthcare, chemical, and a retail sector. So these findings are very important on a basis of estimating a cost of equity. Moving forward, what company specific factor are used to adjust the cost of equity. So as we are aware, there are two types of risk: systematic risk and unsystematic risk. So measured to gauge the systematic risk, that is a beta. So a CAPM, a beta is a part of a CAPM formula. So that is risk-free rate plus beta into the equity risk premium. But to measure the risk, unsystematic risk, as we are aware, that is related to a specific business entity. So measured to gauge that unsystematic risk is alpha. So what company specific risk or alpha need to be used to adjust the cost of equity. So these are the findings. So as we have already discussed, as per the CAPM theory of discount rate estimation, the risk that companies are faced with can be broadly put into two buckets: systematic risk and unsystematic risk. So systematic risk are of a company are dependent on a risk of the overall market or industry and can be eliminated by diversification of investment. However, unsystematic risks are specific to the company and not based on factors that affect the overall market or even the industry. Therefore, unsystematic risk cannot be eliminated by a diversification. So that is a very important guidance. And with systematic risk are represented by beta, as we have already discussed. Which is part of a discount rate estimation as per a CAPM. Unsystematic risk are represented by alpha. So there are various factors that could necessitate alpha adjustment to the cost of capital. So that is company specific risk, and that will be and the respondent to this survey, they identified the company or a project specific risk perceived at the time of evaluation as the bigger factor, followed by uncertainty stemming from conservativeness or aggressiveness in a projection used for the analysis. So as we are aware, the priority of the client will be different from the valuer. Many times actually client come up with aggressive projection. Number one, that after a due diligence, a valuer should adjust those cash flow projection. But wherever it is not feasible, so that can be adjusted through a discount rate also. Most means it can be adjusted through alpha factor. So these are the two factor. I'm sorry. So two factor, alpha and beta. So that is a finding related to what company specific factor are used. And how do you use a DCF technique to evaluate investment opportunity? So there is, we have already discussed, 62% of the respondent consider a DCF method in combination with other method like a peer company multiple or a transaction method. So as a standalone basis, a DCF is not used. That is used in a combination of market approach. That is a company multiple or a transaction multiples. And only 20% of the respondent use a DCF analysis as the primary basis for making investment decision. So a primary method, a DCF is used for a 20% as per these finding. And these proportions are in line with the trend which was observed in a 2017 survey, and reiterate that a combination of forward-looking scientific approach like a DCF along with empirical and relative market-based approaches seem to work best with finance professional. So that is very important, whether to use DCF or whether to use market approach. So important practical guidance we get from this. And then the typical forecast period. So what should be the explicit period? So these findings are very important. So valuation using DCF approach that involves two components, as we have already discussed, a value of cash flow for the explicit forecast period and the terminal value of cash flow. So a terminal value that will be around 75 to 80% of the total valuation estimation. Explicit period projection value will be just limited to 15 or 20%. So explicit period, that is the period for which reasonably detailed forecast can be prepared, and more than half of the respondent showed a clear preference for considering an explicit forecast period of 5 years for a DCF analysis. So majority go by 5-year projection, and that is what the guidance provided under Index 113 or IFRS 13. So that is on measurement of the fair value. So there actually a 5-year explicit period is recommended. So that is what the finding of this survey. And of the remaining responses, equal a proportion of participant, that is around 20% each, they showed a preference for 3 years and 10 years, while the remaining for others. So what is others? So other category would primarily be those that evaluate a finite lived project. So finite lived project, maybe it is 10 year or 20 year. So that will be taken as the explicit period. So finite lived project used the actual remaining project life as the forecast horizon. So that preference of 5-year forecast by the majority of respondents indicated that they typically consider these to be the period for which reliable estimate can be prepared with a reasonable basis. So that is about a finding of a question relating to typical forecast period or explicit period. Terminal value, again, very important. So a terminal value, that is an estimate of the potential value that can be generated by the company or project once it operates at stable level of perpetually. Then most company, a terminal or perpetuity value account for a large part. As I informed you, that will be around 80% of the total valuation estimation. And of the two most widely adopted approaches to estimation of a terminal value, so more survey respondent, they used a Gordon growth perpetuity model or a stable growth rate model than the exit multiple method. So exit multiple method will consider the market multiples. That is exit multiple method, while about 1/10 of the respondent indicated using combination of two. So terminal value, the growth rate is a perpetual growth rate, that is either the going by Gordon growth perpetuity model or the exit multiple method. So that is how terminal value is arrived at. And respondent in sector like infrastructure, power and utility, renewable indicated that since most projects are finite lived, no terminal value is considered, while some of the respondent added that they use asset valuation like salvage value of asset to arrive at the terminal value. So we have got a different perspective how to arrive at terminal value. Mainly it is Gordon growth model, but exit multiple method is also used. Many are using combination of that, and some other are using the salvage value, or they are not using any terminal value, because these projects are finite lived, having a definite life of the project. Terminal growth rate. So benchmark is generally the terminal growth rate cannot be more than the growth rate of the country or economy under which that company operates. So India's growth rate, average growth rate for last 10 years, it is 5.5%. So terminal growth rate cannot be more than 5.5% for the companies which are operating in India. So that is another question which comes to be decided by the valuer in a real valuation assignment. So a terminal growth rate, that is the long-term stable growth rate, a Gordon growth rate. So at which a company estimate to grow beyond the explicit forecast period. An average long-term stable growth rate for Indian businesses is suggested by the respondent, that is approximately 4%, and this is lower than 4.5% average observed in a 2017 edition of this survey, the cost of capital survey, India Insight. So that is about the terminal growth rate. So with that, actually, we have a long session of 2 hours without any interruption. So I thank each one of you for your attention throughout the session and making it interactive. So apart from that, there is a lot from these PPT to be covered, post approach and all. But it will not be feasible, as I told you, even 2 sessions of 2 hours solely on IVS 105. So these are not sufficient. But in the means whatever time was with me, I tried to give as much as input as possible. And again, thank you each one of you. So before we conclude our today's session, so any questions from your side? So we have around 3 to 4 minutes for that. Anything in chat box, sir, your contact number. Okay, Sanjeev Kumar ji, so I am writing my contact number in the chat box. So depending upon your need, you may contact me. So that is apart from that, any further question on whatever we covered today on IVS 105, valuation approaches and methods? Thank you, Umesh ji, for your kind words, sir. Thank you, Lakshman ji.
Sir, it was very nice interaction. Thank you very much.
So kind of you, sir. Thank you very much for your kind
Really,
words, sir.
really, you have tried to cover up everything very nicely. Excellent.
Thank you,
Thank
sir.
you.
Thank you very much, sir, for your kind words.
Okay.
And I thank each participant for conveying their kind words to the chat box. So if no question, then we may end actually this presentation. So Kajal madam, are you there? Can we conclude our today's session?
Yes, sir. This is Sarita saying good evening, everyone.
Good evening, madam. Good evening. Good evening. So can we conclude our today's session, Sarita madam?
Yes, sir. Now it's time to end this session. And thank you, sir. And thanks to all our participants who have to become active participants. And I also want to share that we have other CP lined up for upcoming Sunday and Saturday. So request to all participants, please visit our website for registration. Thank you and have a nice evening.
Okay, thank you.
Thank you. Thank you. Thank you.